Welcome to Money Conversations with KJ. KJ is a lifelong entrepreneur who's made a lot of money, lost a lot of money, and found his way back again. If you're looking for a sterile how-to, you're in the wrong place. KJ and his guests will walk you through real-life situations told by the people who live them, and they are as messy as they are inspiring. Each episode will offer lessons learned, advice on how to replicate successes and avoid pitfalls, and a new perspective to power your financial literacy. Far from a one-size-fits-all, this podcast can help you build a roadmap to your personal promised land. Milk and honey for some, whiskey and steak for others, and remind you that you're not alone on this journey.
Well, hello everybody, welcome back. I'm KJ, the host here. I'm real excited about today's guest here. As I go through my journey in this space of money, we get to come across a lot of folks that are in the same space and can give a lot of value out there. And today's guest is Sarry Ibrahim. Okay, so a little bit about Sarry. Sarry's business is to help high net worth individuals, real estate investors, business owners, and retirees grow and protect their wealth predictably and safely. As a financial consultant, health and life agent, Sarry has cultivated a reputation for putting his clients first, no matter what. He prides himself on attending all client meetings without expectations or preconceived ideas to ensure that he is solving his clients' problems. That's the value Sarry offers. So, Sarry, welcome to the show.
Hey, Kevin. Thank you so much for having me on. I appreciate it.
Cool. Today, I want to talk a little bit twofold today, so the audience can understand, one, where you came from and, why you're in the space and your passion for what you do. And then obviously what you can do for them and guide them in their journeys, depending where they're at in their journeys. And for guys, I know you've listened to a lot of my podcasts. Sarry's going to talk to you if you're at the level that you actually have accumulated some sort of financial, wealth of some sorts, that we've all got to put our money to work. We've got to put it to work safely. It takes time and energy to earn, make, and grow money, and you want to be safely. So he's a lot about asset protection, which I'm huge on that chapter. It's one of the chapters in the trainings that I've done in my workshops that I do. So we'll definitely get into that. But Sarry, let's talk about first. I want to take everybody on your journey. If you can think back, I don't know, as far as you can go, and when you remember that money was something that we used to trade, right? Because that's all money is we trade things for it. How old were you when you figured that out?
That's a good question. So I think it was a really young age, maybe the age of like 10 or 11 years old. I started to realize the importance of money and how it's a tool that's used in everywhere in the world. It has importance, and it's important to grow that money over time and to have a secure source of new money coming in, not just the wealth that you have, but also income coming in on top of it, either passively or actively. So I kind of understood the basics of money, maybe age 10, 11 years old.
Wow.
And of course, I've always wanted to be some sort of consultant, just help people get things done. And it was kind of general, just like a general problem solver. And then went to school, got my MBA. And then I was like, I wanted to get my MBA because I wanted to learn as much as possible about money. And that was just the first step, of course. Your MBA doesn't teach you everything about money. It just gives you a basic idea of money. I got more of my money skills after working in the insurance and financial services world. Insurance on the risk mitigation side and protecting what matters most to people. And then on the financial planning side, it's that we have this money now. How do we grow it? How do we protect it? What do we do with it? That's what really interested me, and that's why I do the work that I do right now.
Awesome. So let's talk. That's a pretty young age to understand that full scope of money, right? And so as I've talked to a lot of my other people that have been on the podcast are like, well, who taught you this? So share with us who taught you, or how did you come about at the age of 10 of realizing, okay, this is what money's for, this is what I want to do, and the path that you went. How did you get there? Who was teaching you?
Yeah, parents had a huge impact on the value of money, of course. It's something that a lot of parents, teach their kids, the value of money and how it's important. But at the same time, there's still a lot of gaps in what people know about money, right? And I didn't know everything, of course, at the age of 10 about money. I only knew just it's important. That's the only thing I knew about it.
Right.
But I just had always this curiosity about where does money come from? How do you make more of it? How come some people have a lot more money than other people? Like what causes that discrepancy or that delta between people who have a lot of money and people who don't? And then, of course, going to college, growing up, going to grad school, working in the industry, you learn a lot about this, and it has a lot to do with financial literacy, which is a lot of what you talk about. There's knowledge that has to go behind money. It's not just having the money that doesn't help, really.
Right.
You see a lot of, for example, you hear stories about like kids who inherit a lot of money at the age of 18, and it ruins their life because they didn't know what to do with that money. So it's not the financial matter, it's the literacy behind it, the knowledge and what to do with it and how to grow that money behind it. That matters more than the actual sum of money. So it's not the money that you have, it's how you get it and what you do with it after you get it, the knowledge, the experience behind it. And I think that's what I wanted to center the business around a lot, around teaching people how to apply these skills. And I actually just found, I just made a podcast called Thinking Like a Bank. And the podcast, the intent of it is to show people what banks think and how they think, so that way anybody can mimic these thoughts. And it's not exclusive for bankers or financial reps, but anybody who makes money and has money to think more like a bank and copy what the most lucrative industry in the world has been doing for thousands of years in the way they handle money.
I think that's awesome because, in my course that I teach, the first one out of the gate is mindset. And you just described, your podcast is 100% about mindset. If we really don't learn how to think and act different with our time and money, you'll end up like the masses. And we know that 95% of this population and probably the planet, don't accumulate any kind of wealth because they don't know how. They were never taught. And so going back at 10, you were mentioning how your parents taught you, which very fortunate that your parents taught you, because I've spoken with thousands of people, and whether you realize it or not, unfortunately, parents aren't teaching their kids about money. Mm-hmm. And we find that there's two reasons. Money can be a difficult conversation to talk about, right? For a parent, sometimes it's on the same planes as sex, right? Your kid gets that 13, 15-year-old age. You're like, man, I got to have this sex talk. Man, that's an uncomfortable talk. And a lot of parents don't have that talk. And same goes with money, right? If your parents struggled with money, then they can't teach you about money because they struggled. So I have a little saying that I say, listen, parents can't teach what parents don't know. Mm-hmm. So fortunately, it sounds like for you, your parents taught you. So were your parents good with money?
Yes and no. So,
okay.
So there was kind of like an up and down part growing up, where like my parents had money and then they didn't have money, then they had money. So I saw like both sides of the world, where you don't have money and you do, and that kind of changed a lot of the way I know. So they always influenced me to save, always influenced to don't ever assume that tomorrow is the same as today as far as financial economic means. It's not. It could change at any time. And I think that's one of the main reasons why they influenced me to save, is you don't know what's going to happen. You don't know if you're, and then they would say when you grow up and you get you become an adult and you have a job, even then you need to save, because you don't know what's going to happen in your career. You don't know what's going to happen with your health. You can get sick, you can get hurt, your job could be changed. You don't know what's going to happen. So having that financial background, or having something in the background that's working for you, and a way to access money if something were to happen to you, is important. And we see this a lot with what happened in 2008 and what happened right before COVID hit. A lot of people didn't have those planned out, and these were just cycles throughout history, is that a lot of people don't plan on the next economic downturn or the next huge problem in the economy. But having that, you need savings, you need a way to grow that money over time, so to outpace inflation, to outpace other risks. You need some sort of vehicle that can keep driving and going through the downturns and the downsides.
I agree. And so it sounds like, at 10, when that really piqued your interest, because it's funny, that's a really, I've got 4 grown kids, and between 10 and 12 is when kids are figuring out what they really, their minds, what they're doing. And some kids will go down like sports, right? I'm going to go become a baseball player or football or whatever. You could get into music. And when you get into some of these other passions that we all will, have in our lives, then we forget about the money, right? And you think like if you want to strive to be a professional baseball player, one of the reasons is the excitement and the love of the game. But obviously, we all know that major league players make a lot of money, right? But that being said, we also know that a lot of these kids who will be groomed from the age 10, go all the way through, become their professional sport, whatever it is, make millions of dollars, finish their careers, and then what happens? They end up being broke.
Most of the time. Yeah,
Most of the time. Not all the time, but most of the time. And that's because no one ever taught them about money. So they followed their passion. They got awesome at it, went and did it, and they weren't listening to the right people. And unfortunately, those type of people end up listening to the wrong people who want to basically take advantage, right? And take their money from them. So that's interesting that at 10, money was your thing. You were just so interested. It just intrigued you at that age. Like, man, what is this? I got to know more about this money. I want money. You know what I mean? And you look a fairly young guy. How old are you?
I'm 31.
31. See, so you're a young guy. I got kids older and younger than you, but the journey with money at 31 and everything you've learned, I mean, you're so far ahead of the curve than the average 50-year-old. I could tell you that right now. For sure, 100%, right? And this is why, for me, Money Conversations, which is fueled by Fintel, is I teach financial literacy, what I like to call it the 5th grade level, the fundamentals, the things that we basically should know that you learned probably between the ages of 10 and 15, right? And that's why you're able to teach what you teach today in today's world. That's super fascinating. Talk to me in the audience about, as you were learning this, right? Were there other passions that you were following in life, or you 100%, man, I just love this whole money thing?
Yeah, I always liked the money, and I always felt like even at a young age, even before I knew much, I always felt like I had the solution already in mind. Like I already knew that like people have financial problems, but I had the solutions already. I just didn't know much. The only thing I knew was save your money. That's it. And that's a vague thing, right? It doesn't work for everybody, and it depends. But I always knew that I had some sort of ideas to help mitigate problems or eliminate some problems, which is what influenced me to get into the industry and doing what I'm doing right now. And to kind of give a little bit more of a continued story, I started to work after I graduated my MBA, I started to work in insurance, and I was working primarily in the Medicare field. And that was really cool because I got to work with a lot of retirees, people who were like 65 and older. And I was helping them transition from their Medicare plans to their own individually owned plans, from their employer plans onto their own plans. So they were leaving work or their unions, whatever the case was. And I was helping them make that transition. And it was cool because I would see like the end result of saving up in the future, having a pension and all that. And that guy kind of gave me a perspective on what to expect in the future and even some things how to improve, from the conventional or traditional ways of saving for retirement. And as I was making these changes, one of my clients, it's all about the curiosity. One of my clients asked me, hey, I heard there's life insurance that has cash value that builds up over time, and then eventually the policy will pay for itself. That was all I heard. And I didn't know much of what he was talking about, but I was like, hey, you know what? That's a good idea, because you could build up cash somewhere. And if something happens to you, you have life insurance, and then eventually you can get the cost back that you paid into it. So it kind of just triggered a whole bunch of light bulbs, and I wasn't really sure what he was referring to. So I decided to do more research. And I went to Amazon and I searched for books on life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. Mm-hmm. And Pamela Yellen invented the bank on yourself concept and the utilization of this strategy called the bank on yourself strategy. So as I was reading this book, I was like, this is very relevant, not just to my client who was thinking about cash and value life insurance, but also to anybody who wants to eliminate financial problems in the future. It gives you the ability to save money. It gives you the ability to grow your money regardless of market conditions, the tax benefits behind it, the ability to borrow against it and use for other investments like real estate and your business. So there's a lot of things were going on. And I was like, I want to do this. I want to implement this for all my clients and all my friends and my family. I want everybody to know about the strategy because how powerful it is. So I became a bank on yourself professional. And then I started doing guest podcasts, things like this, and just explaining this concept and how the power of it behind it, because of all of the financial problems out there and the lack of literacy behind the lack of understanding or financial literacy behind this. So this is why I think this concept is really important. And I recommend 2 books to get a better idea of this. The first one is The Bank on Yourself Revolution by Pamela Yellen, the book already mentioned. And the second one is Becoming Your Own Banker by Nelson Nash. These 2 books give a really good idea of what this concept is and how it could eliminate a lot of problems, a lot of future financial problems for people.
So that's great, because obviously that's tailoring towards people that are, I'd like to call them the 4th quarter of life, right? 60 plus years old, right? So we've got to talk to the people that aren't there yet, right? That it's great if you can finish the fourth quarter of life, that you've done some things correctly and set up some of these types of policies. And whether it's that, or you've just opened a self-directed, retirement account, there's a lot of different vehicles to use. And then actually, it sounds like, your expertise is saying, okay, now you're here, which means you're going to stop trading time for money. You're not going to have a job. So you need to make your money make money. Right. Yeah, and just FYI out there, guys, you don't need to be 60 or whatever years old or older to be able to do that. Really, the goal of the game is to get there as early as possible. I mean, if you can get there in your 20s, and there are people that do that, you want that. You want your money making more money than whatever you're going to do to trade time for it. That's huge, number one. But you're helping people because they've worked hard their whole lives doing whatever they did, and they're thinking, they don't know what to do with this chunk. Whether that chunk is 50, 100, 2, 3, 4, 5, whatever the number is, they're unsure. And so they need an expert like yourself to come out and help them out. And like we said, do it safely, predictably. Nothing more important than asset protection, guys. When you're out there, whether you're 30 years old and you're like, man, I got $100,000. I saved $100,000. I've invested. I have $100,000. How do I protect this? That some yahoos come along, sue you, and take it, right? And it's so important, vitally important, to do that, because we all work really hard either for the money or investing it as wisely as we can to accumulate it. So as we talk, so you decided to go down that path in your career. Listen, I'm going to go solve problems with money. That's what I want to do, right? Mm-hmm. And you're 31 years old, and you've helped a lot of people. What have you done for people? Have you come across, as we're in that arena, somebody, let's say, that was late 50s, early 60s, that only accumulated 10,000 or less? What do you do for those guys?
Yeah, so at that point, exactly, it's a good question. And at that point, it's kind of, there's not much we could really do as far as a financial strategy if they're 65 years old and they have 10,000 saved up. But at the same time, because of especially if they're no longer working now, they might just have like a pension and Social Security, depending on what the analysis is or what the situation is. But one thing that we could do is start planning for the next generation now. And in some situations, it's kind of hard to get approved for life insurance at the age of 65. It's possible, but it's a little bit harder to do just because of the risk for the insurance company at that point. But it's possible. And I've actually helped people over the age of 65 with limited resources to go to the next step of having life insurance, and even being able to take control of their money that they're making. So it's also too about the income, not just about how much cash they have. So they might have $10,000 saved up, but they might have, $3,000 a month in passive income from Social Security and pension and other areas. That was what we could really make that work as far as funding the next generation and funding life insurance. And again, just to be clear, Kevin, it's, all the strategies here we talk about, that bank on yourself strategy, it's like you said, it's applicable for everyone, people from the age of 18 to age, 90. And I really wanted to kind of dive a little bit deeper into this concept, the bank on yourself concept. It helps people take back control of their financial life. It helps them kind of, so for example, when you buy something, let's say you want to buy a car, there's typically only three ways to do so. You could buy cash the car, you can finance it from the lender, or you could lease it. And each one has its pros and cons. But what if there's a fourth way? What if there's a way that you could buy the car with money from where you borrow from yourself, pay it back on your own terms? This way you pay off the car and you can get all back the interest that you would otherwise pay to other people. Because when you pay cash for something, you lose the opportunity cost you could have earned. So if I take, for example, $20,000 from a savings account, and then I move that over to a car and I buy a car with that, I can no longer earn interest on that car anymore. Let's say now I finance it. If I finance it, then I pay the interest to the lender. If I lease it, I'm just renting the car for 3 years or 4 years. And then if the fourth option, where the bank on yourself concept comes in, I could have my $20,000, borrow against that, finance the car, pay it back on my own terms. 5 years later, I have a policy now with probably twice the amount of cash value in it, Plus, I had the car already paid off. So now I did two things with my money. I was able to grow money and use it at the same time. And this is what I want a lot of people to understand, is that you could do both. You can grow your money and become your own source of financing. Again, we finance everything we own. Everything we touch, we finance, either through cash or through the actual lenders or credit cards or different ways. For the average American, 1/3 of every dollar earned goes to service debt. So if you make $100,000 a year, $33,000 goes to service debt. Student loans, auto loans, mortgages, credit card debt, personal loans, loans on your furniture, loans on everything else. So 1/3 goes to service debt. What if we could be on the other side of it, where we're sitting on the other side, earning the interest back in our pocket? This is what the concept talks about, and this is what we help people do. We help them take back control of the interest they would otherwise pay to other people, to redirect that back into their pockets.
Right. And I love your example. It's an automobile, but guys, you can do this. And I know lots of people, and I've done it. We can do this with real estate. And I think that's probably the biggest one, because, we're talking ticket items here, right? Car. And I mean, a decent new car today is darn near 50 grand, right? It's ridiculous. Yep. And you can go out there if you're, one that's whatever, 40, 50, whatever, and you've done the right things and built up your retirement accounts. Yes, become your own bank. And the greatest thing about that is the IRS does not tell you what interest you can charge yourself. So when we're paying somebody else interest, obviously we want to pay the lowest interest possible, right? When we're paying it out. But when you're paying yourself, and and this is great for your taxes, and you're like, yeah, I'm going to charge myself 10% interest. And it sounds counterintuitive, because we're always thinking, I need to get the lowest interest rate possible, right? But when you're paying yourself, no, because that 10% that you're charging yourself is tax deductible. It's great. It's great. So guys, when you're out there, again, whether you're doing your car, you want to do real estate, you want to loan money to people. I mean, go ahead, loan money people. You're like, I loan money. It's 10, 12, 50. You charge whatever you want. I know people that charge 20%. Hard money, right? Hard money is anywhere from 15 to 25%. So become a hard money lender. Become, like Sarry is saying, become the bank. How do you think these banks become so wealthy? They make so much money on our money. Well, yeah, become the bank. It's just one of the concepts that people don't even think about, don't know. So I think it's awesome that you share that out there. You're doing it with a little more of the early retirees, but I mean, whoever's listening to you at whatever age, understand that concept. That's really cool. So on some other levels that you teach besides that, which is, when you're consulting with them with their health and their life, so you've learned about life insurance and the different types of policies, what kind of recommendations? Because, there's a lot of arguments on life insurance. If you listen to somebody like a Dave Ramsey or a Susie Orman, they're going to 100% tell you, do not do any whole life. They're such advocates of not doing that, right? They're talking about term life insurance, which is a whole different animal. And it depends where you are in life, which one that you really want. I think whole life is designed for people with money, so you can leverage that money. It's very expensive. It can be expensive for a lot of folks. What is your advice on going down that road?
So yeah, you're right. So a lot of people do listen to like Dave Ramsey or Susie Orman when it comes to whole life insurance. And there's whole life insurance is never just a one size fits all. It's never just a one type of solution. It has a lot of different variances. It's different in different companies. There's different ways to fund it, different ways to structure it, different ages. There's a lot of differences. And one of those things, for example, we work with there's about 1,200 insurance companies in the US that sell whole life insurance, but we only work with 3 out of 1,200 insurance companies. Why? Because we want to make sure that they could address all of the functions we want them to. So it's not necessarily about the title of it. It's called whole life insurance, but it's about the function. What could it do? If we want to take back control of our financial life, we want to have liquidity. We want to be able to grow money over time, regardless of market conditions. There's a certain checklist we must follow in order to do so. Number one, in order to do so, it must be a whole life insurance policy with cash value. It doesn't work with term insurance or universal. It must be whole life insurance, and it must have cash value in it. Number two, it must be from a mutually owned insurance company. There are 2 types of insurance companies. One, mutually owned, and the second is stock owned. Mutually owned is where the customers own a part of the company, and they get back dividends from the company. Whereas stock owned companies, the dividends go back to the shareholders. So we need to make sure it's a mutually owned insurance company. And then number 3, there's something called the paid up additions rider. The paid up additions rider is a part or a piece you add to the policy to help turbocharge the cash value of the policy. It also helps with flexibility, meaning that 1 year I could add in $5,000 a year, and the next year I could add in $1,000, and then the third year I could add in $20,000. You could do this through the paid up additions rider. The rider helps, and then as the rider is added, it inflates or increases the cash value in the policy over time quickly than without the paid up additions rider. And the fourth is you need to make sure it's a non-direct recognition company. What this means is, let's say we have $100,000 in cash value in the policy. Now, let's say we're also real estate investors and we want to buy a property that costs, $90,000. We can go to the policy, borrow against that, take out $90,000 from the policy, borrow against it, and then use that to become our own mortgage, essentially buy the property with that. And then we have a loan now with the insurance company. But non-direct recognition means that when we took out that outstanding loan, we're not subtracting from the value. We're borrowing against it from a different source. And when we do that, our $100,000 cash value, the original cash value, keeps earning interest and dividends on that money over time, even when we're using it. So let's say 5 years goes by, we sell the house for $150,000. We made a $50,000 profit off that, considering other costs too. And then we also made money in the policy at the same time because we kept earning interest and dividends over time without interrupting the growth of that. So our money did two things for us. It grew in the policy and it grew outside the policy. And it gave us the freedom and the liquidity to do both. So just these four qualities for whole life insurance, mutually owned, paid up additions rider, and non-direct recognition. These are things that Dave Ramsey and Susie Orman have never talked about, these four qualities. And they're not obviously whole life insurance agents. They're not financial planners or financial advisors, so they don't know how these things work. So when it comes to utilizing the infinite banking concept or the bank on yourself concept, I would not listen to Dave Ramsey or Susie Orman. They say some good things, right, about having a healthy financial life. But again, we're not talking about all whole life insurance products from all companies. They have to be structured the right way. If they're not structured the right way, they could lead to the things that Dave Ramsey and Susie Orman talk about, such as it's a terrible investment. It has very tiny cash value. You could borrow your money and then end up paying all the interest back to the insurance company. All those situations, all those negative situations could be true. It's not relevant to every single insurance product out there, every single whole life insurance product out there. It could be though, if it's not structured the right way, which is why you need to make sure you're dealing with a bank on yourself professional or an infinite banking concept professional, somebody who does this full time, who does it for not only has a whole life insurance license or a license to sell whole life insurance, but also somebody who's competent and familiar with the utilization of dividend paying whole life insurance for self-banking purposes.
Excellent explanation, because it all comes down to one thing, guys: education. You got to educate yourself, and educating yourself for your needs. Finances are not a one size fit all. We are all different. We all have different aspirations of, what our end goal line is and how we're going to get there. And there are a lot of different lanes to get to the end goal. So Sarry just explained to you the value of education and understanding, right? That there are literally just a small handful of companies that are going to be able to do it correctly and save you. Don't kid yourself when there's a lot of insurance companies out there. Listen, they just want your money. They want to make money. In any given city, USA, the tallest buildings in any city downtown are insurance buildings, okay? There's a reason for that. So they do make a lot of money. So doing your education, I think you just did an awesome explanation and laying that out. So if there's people out there, they're on the fence, I'm not sure, what does it mean? There's multiple different kinds of whole life. And if you got an insurance agent just says, hey, I want to sell you some whole life, you got to say, what kind? What kind? What are we talking about here? Right? Awesome. Great explanation. Big value out there for that. Big value. So many good things. And again, when you're 25, 35, 45 years old and you're thinking, I need to accumulate cash. And, I teach one of the things, you're either going to be an active investor or a passive investor, right? You either, Sarry here took this on early in life where he just, the curiosity bug bit him early and he just dove deep into it. And most people don't. Most people like, it's a whole other language. I don't know it. It's hard to understand. So go invest passively. And there's plenty of places that passively where you got to put your money in places and let the pros do what they do. And you're the benefit of doing that.
Exactly.
I think, and when we're talking about asset protection, right? Meaning we want to protect that wealth. How do you protect the wealth of people when they have those kind of dollars? Or what are you suggesting?
So this is something you definitely want to talk to an attorney about. I'm not an attorney, so definitely consult with one before you do this. But there's some general ideas that you can think of. And here's one kind of, I guess, thing that a lot of people don't know. Sorry. There's one thing that a lot of people don't know, and that is that whole life insurance in a lot of states, the cash value of it has a lot of asset protection behind it. So, for example, let's say that you're in the state of Illinois and you have $100,000 in cash value. That is protected from creditors and outside risks. And the same is true in Florida. If you have cash value life insurance or annuities, that cash value in there is protected. And one strategy behind asset protection is you could intentionally take out whole life insurance and have your money sit there, and it's still accessible regardless of the outside risk. So it's a safe place it's like a bank account that you can have cash value in it, and then it's accessible to you, but other people can't touch it. They can't even know about it either. It's not public information or public records. And even if somebody did find out about the cash value in it, they wouldn't be able to, and in a lot of states too, they wouldn't be able to leverage that in a lawsuit or have a judgment against that because of the way the law treats life insurance. So in most states, the government looks at life insurance as a good thing. They want you to protect it. They want you to have it for your family, and they don't want outside risks to affect your life insurance insurability. Because if you have, for example, $100,000 in life insurance, and depending on the state you're in, and then somebody sues you and tries taking that $100,000 out, then you just surrender the policy, and now you and your family are out of life insurance. So the government wants to deter from that by protecting the life insurance, the cash value, and then you could utilize it for whatever purpose you want. You could always borrow against it. There's never any credit check behind it or collateral needed to borrow against the policy. The policy itself is self-collateralized. So if you have $100,000 in the policy, you borrow $90,000, the insurance company is giving you a $90,000 loan, leveraging the death benefit and the cash value you have. You don't have to put up personal credit. You don't have to show proof of income, co-signers, any of that. You have guaranteed liquidity, guaranteed loan provisions in the policy that give you the right to the loan at any time up to 90% of the cash value for any purposes. So imagine you have this, you're going into business essentially with this insurance company that's been around for over 160 years. They've been paying dividends and interest, and you are going to be a policy owner slash mutual owner of this insurance company, and they'll always guarantee you, no matter what your cash value is, they'll loan you out 90% of it, or you can surrender the policy if you wanted to. But the guarantees are always there, and the liquidity is always there behind it. So there are other solutions out there for asset protection, but a lot of them entail kind of parking your money somewhere, not being able to access it for a certain amount of time, charging high fees for doing so. There's a lot of different ways. In my opinion, I think the best form of asset protection is having dividend-paying whole life insurance in your portfolio. I've talked to asset protection attorneys before, and they say the typical asset protection plan costs about $30,000 to set up, and then like $2,000 or $3,000 every year after that, and maintenance fees this is aside from the money they're investing or putting into a trust or whatever offshore account. I don't really understand how those things work. I just know that whole life insurance could be a beautiful part of your portfolio, especially when it comes to asset protection. And of course, you want to do this with the guidance of an estate planning attorney, an asset protection attorney, attorneys that understand various laws in different states and how whole life insurance is structured. And of course, the tax parts too with your accountant also being in your team.
Yes, 100%. I just want people to understand asset protection and what it really means. So for everybody you're out there, you're accumulating money. Unfortunately, we live in a very litigious society. People will sue you for darn near anything. I mean, anything. Oh, yeah. And the thing is, once, Joe Smith or whoever goes and wants to sue somebody, and he's going to go talk to Mr. Lawyer, and Mr. Attorney's going to do a little bit of homework. And that homework he's going to do is research what kind of assets is, Mr. Sewer guy trying to get. And if that attorney cannot access assets, he's not going to sue, because attorneys do not work for free. None of them. I've never met one yet. Matter of fact, they're opposite than work for free. They charge a lot of money, right? Yeah. So asset protection is about protecting your assets, and there's lots of different vehicles. You just explained one of them. Every state is a little bit different. When you start accumulating real estate, you start accumulating cash wealth, parking it wherever you want to park it. It's all about visibility. Now, I had a asset protection specialist on the show here a couple, 3 months ago, whatever it was. And the best way to be able to, for the average person, unless you really start accumulating a lot of wealth, it can definitely get a lot more complicated. But to keep it simple for you guys that are out there that are working hard and you're starting, I got 30,000, I got 40,000, I got 90, I got 100, I got 200. Which is a lot of money. Don't kid yourselves. But there's people out there with millions and tens of millions of dollars, and they want to protect that stuff. You need to incorporate yourself. You need to hide your money inside of corporations. You do not want to be exposed where your money is in your name. There's a saying out there that all the wealthy know: own nothing, control everything. You heard that phrase?
Yeah, definitely, for sure.
Yeah, own nothing, control. That just means you control it, but when some attorney wants to come after you and they're suing your personal name, well, guess what? There is nothing in your personal name. When you protect it correctly, put it inside corporations. This is what all the wealthy do. They put it all in multiple corporations. I have 5 corporations I level out in, right? So if somebody wanted to sue me, I say, well, you can have my shoes because that's about the only thing that's not in my corporation, right? So go ahead, roll the dice, spend your money on your attorney, and they're going to tell you, I can't get nothing. So I love that subject. I loved it tremendously. I think it's an invaluable. And do you find yourself, Sarry, when you're out there and you start talking about asset protection to people, do you find that they're like, this is a foreign language? Like, hey, no one ever told me about this. I never heard about this. Do you find that to be normal?
I find it to be normal that people don't even think that's something to consider. Like, meaning like, oh, I'm not going to get sued. I don't do anything wrong.
Right.
And the reality, like you said, we live in a society that's super like ready to push that lawsuit button. And a lot of times, a lot of rich people, they just come across problems where like they get sued because they have a lot of money and it was just an opportunity for somebody else. And they'll say like, yeah, I sold this product or I did this service for somebody. It was, I documented everything. They sued me for, whatever. I just wrote them a check for $10,000 because it was cheaper to do that than to hire my lawyer and then to pay my lawyer, $500 an hour and defend me for the next few years. It was just easier. And then that's the society we live in now, where it's just easier for rich people to just write it off in that sense. But yeah, and again, it's not about your ethics and your morals and getting sued. It's just about the ability that you had a lot of money and somebody had a perfect opportunity for that, to take some of your money.
Yeah,
it's just an opportunity thing. And
it's happening just more and more every year. Yeah. It's just really you've got to get really tight on this stuff, guys. You really, really do. Because again, when you work as hard as you do and you're trying to do all the right things, setting up all your right accounts, thinking that the finish line is close here, I'm going to have $X and live the lifestyle that I want to. And then in one fell swoop, something silly could happen and you're like, holy crap. I'm 70 years old. I got to go back to work. So they took all my money, right? And nobody wants me to be in that position. That's awesome. Good stuff. What do you think's been the biggest challenge as you're out there talking to these people? What's kind of a good common challenge that people are having when you sit down and talk with them?
A lot of challenge that people have is they don't see things. A lot of people are based off of what they know on a conventional basis, meaning that what everybody else does and what everybody else has been doing. Like, for example, somebody who has their job and then they have a 401k and they might have like a brokerage account and then like term life insurance, and they might think they're set in every way. They got their passive income, they have their active income, they have life insurance if something happens to them. And then it's like when we go through the analysis, we're identifying certain risk points, such as with the 401k. A lot of it is going to be in the stock market. And the stock market, of course, is always subject to volatility. That anything could happen that could affect the value of the 401k. So a lot of people don't see that coming. The term life insurance policy has a set end date. So if you're 30 years old, you do a 20-year term policy, it's going to end at the age of 50. Well, what if at the age of 50, you get diagnosed with a condition? Now you can't reapply for that term policy. And if you could, and you do get approved, it's going to be about 10 times more than the cost. So they don't see that life insurance aspect of it. They just see the term only in that set period of time. And then, of course, with their job, like if something happens to their job with their active income, how do you replace your current income? What if something happens to your industry that you're in, or some other part happens in the market where it's going to hinder your income? So once we start identifying all these things, people just start like rubbing their eyes and their heads are like, oh my God, this is too much to take in. And then we even talk about there's even more like taxes. Right now the highest tax rate on the federal income tax rate is 37%. well, what's going to happen when that goes up? And I think it will go up in the future. What if it goes up to 50%, and now you're making $300,000 a year? 50% of that is going right to the government on a federal level, excluding the state taxes that you have to pay. So people see all these things and they're like, oh my God, I thought like everything was going fine. I didn't see any of these things. So people are looking today. They're looking at their checking accounts today and their savings accounts today, and they're basing it off of how they feel in that moment. All right, today's good. I have enough money. I can pay my bills. I can pay my mortgage. I can pay my taxes. Everything's going smooth. But we need to keep looking beyond the next 10 years, the next 20 years, the next 30 years, 40 years, into retirement, to have a real financial plan, because it's going to come. It's just a matter of time until it gets there. So if you could just do some minor tweaks, and we never want to position something where it's going to add an additional expense for somebody or an additional problem for somebody, like the utilization of dividend paying whole life insurance within the portfolio. We're not doing this to add an extra bill. We're doing this to reposition current dollars, meaning that you're already making money and you're already spending money. What if we can reposition those dollars in a way that would benefit you and your family and your business for the long run?
Right. Again, I think more importantly, for everybody out there, there's no one size fits all, right? You really need to be proactive to get out there and talk to specialists, maybe someone like Sarry, talk to your attorney, talk to your asset protection specialist. It just depends where you are in your journey of life, right? And listen, your journeys all should start at a very, very young age, right? Sarry started at, the bug bit him at 10, and he really got to be knowledgeable, went to school for it, where a lot of folks don't even think about money until they actually start what they believe making money. Like, not just your little part-time job when you're in school or something, but they actually get their careers going. They start making, 75, 100, 200 grand a year, whatever it may be, before they start thinking about it. And guess what? You're behind the 8 ball already. Don't wait until your whatever career path you're going down, that that career is going to pay you whatever 6-figure income. You need to think about that way early to be able to practice. But one, these products that you're talking about here, the younger you are, the less expensive they are. The older you are, the more they cost. So don't wait till you're 30, 35, 40 years old. Man, if you thought about that early at 21, you're literally probably paying 50% less than if you're at 31. It moves that quickly. So be proactive. Think about where you're at. There's a lot of people out there that start their families at early 20s. It happens all the time. They're single moms, single dads, whatever. Listen, think with your money. What is my game plan? Who do I need to go talk to? And I think if you can, and I'm going to leave your information down below. This will be on the podcast and on my YouTube channel, that if you want to contact Sarry about that, I'm sure you'd be open to talking to some people, Sarry.
Oh, absolutely. Yeah, they can go to our website, finassetprotection.com, FIN assetprotection.com. They can schedule a free appointment. Also, I already mentioned a book called Becoming Your Own Banker by Nelson Nash. I'll throw in a free copy of that book if you reach out to us. You don't have to schedule an appointment yet. You can just reach out, ask for the free copy of the book, and I'll send it to you for free. I'll email it to you. And then, it's finassetprotection.com.
Cool. Awesome. That's a pretty good gift, guys. You got to take advantage of these things when we're going through life. And if you're fortunate enough to be listening to this podcast, he just gave you a huge freebie. I mean, huge. This could be the shift, in life. If we cannot connect the dots going forward, we can connect them going backwards. And when people are like, I'm almost 60, and if I look back in life at 25, if I would have made a pivot decision, how my life would have changed. And the offer that Sarry just gave you could be a pivot decision in your life by taking them up on this offer. So, hey, I really appreciate that. And hopefully you guys out there listening appreciate it a lot more than I do. I mean, I'm good. I set myself up a while back. I just enjoy doing these podcasts. So I really enjoyed talking with you today. Any last advice you want to give someone? I like talking to the younger people. What would you give let's say you're 31. What would you give your 21-year-old self advice, knowing what you know today?
I would say that, so the best thing about growing wealth is compound interest. And compound interest is always better yesterday. It's always better in the past. In other words, the sooner the better. As somebody who, if I was telling my 21-year-old self, I would say, put your money somewhere that you can access it in the future at a higher rate of return. and that's still accessible too. So we're not just locking up money and never touching it again, but put your money somewhere that grows and is still accessible over time. Also, figure out a way that all the money you're making right now, figure out a way to bring that with you into the future. So you have, the money that you're earning in one hand, and then in your other hand, the money that you're spending. But how do you make the money how do you keep more money? It's not just about making more money, but how do you actually keep it? How do you actually bring it with you into the next generation, the next decade? How do you bring it there? How do you bring it to your kids? Keeping the money in the family, such as a lot of people call the strategy the family banking strategy too. How do you keep it in the family? How do you keep this money growing over time? That's what I would tell myself. And I would tell this exactly to people who are young, somebody who's 20, 21 years old, just started a job, or maybe they're still like in college saving up. You could do this policy with like $300 a month, and you get that money back plus more, plus compound interest, plus the ability to borrow against it. Plus you'd start off at a young age thinking like a bank,
Yep.
You would. So that's one thing I recommend is you want to think like a bank, not just a consumer, not just a saver, not just somebody who puts money, not just somebody who gives money to banks and have them do it, but how can you take control of those finances? How can you think like a bank and protect more of your money and keep it with you? Again, it's all about keeping your money.
Great advice. Great advice. Wow. Great value today, guys. Again, thanks for coming out. Sorry. Again, I'm going to put all that information down below so you guys can access them, because there's plenty of people out there that can use this advice. And again, man, the earlier you start, the better. And do me a favor, guys, learn this stuff, and we need to share this information, right? The only reason we're in the 95%, 5% in this country, meaning 5% owns 95% of the wealth in this country, is because people aren't teaching people. So talk about it. Get out there and talk with your family, your friends, everybody that you can. So Sarry, thanks for coming out. I enjoyed it.
Thank you. Thanks for having me on.
And for you guys out there, remember, I put out my podcast every Wednesday, 7 a.m. Got another one coming out tomorrow. Sarry will be out in about 2-3 weeks. And for you guys that are watching me on YouTube, hit that like button, hit that subscribe button. Love to have you just keep coming out and listening. A lot of great lessons. I got a lot more really interesting people coming out and teaching us some really good stuff. So, Sarry, we'll see you on the other side.
Thanks, Kevin.
Okay. Bye-bye.
Hey everybody, hope you enjoyed that episode. Really enjoyed making all these episodes for you. Remember, we're just having conversations with people's journey with money and the things they did right with it, the things that did wrong with it, and how did they really come about getting their mindset with money. So every episode's different. We all have a good takeaway from them. So do me a favor, hit the like button, smash the like button, and subscribe to my channel, because every episode that I do is going to be different, as all our journeys are different. So you guys take care, and we'll talk to you next week.